Today is November 29th, 2024. This month, emerging markets continue to lose ground. They are down approximately 4% in US dollars and 2% in euros. The uninterrupted rise of the US dollar since September has prompted American investors to repatriate their foreign-held financial assets back to the United States. This movement accelerated following Donald Trump's decisive victory in the US presidential election, a win that raises concerns about a significant increase in tariffs, penalizing non-US exporters. In this context, all emerging markets as well as European markets are under pressure. In China, investors fear a substantial impact from US protectionist policies. Furthermore, the economic support measures announced by Beijing in mid-November have failed to impress. South Korea and Taiwan are declining not only due to these American concerns, but also because of the current uncertainty surrounding DRAM memory prices, which now seem affected by Chinese competition and weak global demand. In Latin America, Mexico is falling due to the risk of additional customs duties, while Brazilian stocks, along with the Brazilian real, are suffering from the fiscal laxity of Lula's government. In this uncertain environment, only India is standing out. After some profit-taking in October, the market demonstrated resilience in November despite the announcement of mixed results for the second fiscal quarter.
Has Donald Trump's victory caused uncertainty in non-American markets? How do you assess its impact on emerging markets?
In 2016, emerging markets were initially affected by the victory of the American provocateur. But in 2017, the rebound was spectacular, plus 137% in dollars on the emerging index. It's worth noting that the US dollar had corrected by 13% against euro. Over the entirety of President Trump's first term, emerging markets rose by 50% in Dalao. Therefore, one should be cautious about short-term reactions. That said, with American protectionism and economic challenges in Europe, the international environment remains uncertain heading into 2025. However, emerging markets have many local strengths: a stimulus plan in China, sustained Indian growth, a program to revalue undervalued assets in South Korea, and monetary easing in many emerging countries.
You mentioned these emerging market strengths at the local level. What are the details?
The first strength is in China. By 2025, the exports share in GDP growth will decrease. As a result, Beijing is expected to intervene to take action to boost domestic consumption and investment to maintain growth at around 5%. These measures should benefit our selection of stocks, which represent 26% of the GEM equity portfolio. The second strength is in India. We estimate that public and private investment will continue to grow significantly and that rural consumption should recover. The Indian market has recently consolidated and is once again attractive in terms of earnings growth. We have recently increased our weighting, which now exceeds 21%. In these two markets, the significant presence of domestic investors helps reduce volatility caused by international investors. The third strength is South Korea's program to revalue undervalued assets. Modeled on Japan's example, this program encourages undervalued Korean companies to take measures that benefit minority shareholders. This is the case for Hyundai Motors, Kookmin Financial, and Korea Telecom, in which we are shareholders. Elsewhere, in Indonesia, Mexico, and South Africa, monetary easing presents investment opportunities in the banking sector.
What risks could affect these investment themes by 2025?
In the short term, the international environment is likely to remain volatile, at least until President Trump officially takes office in January. In Europe, economic conditions may deteriorate throughout 2025. On the geopolitical front, fewer elections are expected, but tensions in Sino-American relations are unlikely to ease. From an execution standpoint, China's stimulus measures could fall short of expectations, as has happened in the past. This is why we are cautious about increasing our overweight position in Chinese equities. In the technology sector, uncertainties remain regarding DRAM pricing, which largely explains Samsung Electronics' disappointing performance in Q3 2024. this mid-cycle correction may last longer than anticipated. Within this sector, we are focusing our investments on the AI value chain, approximately 25% of the GEM equity portfolio, as this segment continues to offer strong growth prospects through 2026. We thank you for your trust and loyalty.